Hi everyone, today we are going to discuss one of the most important and key tools of every technician. I don't think there's anyone who goes without using it, and everyone who's new to charting and is looking out for that holy grail. I'll tell you, while there's no holy grail, and people do ask questions like, which moving average is best to use, and they're probably looking for a number, and that number could be 9 days, 14 days, 20 days. The real answer is that it doesn't really matter. What really matters is how you use a particular indicator or a particular tool. And the most important tool, like I said, that we're going to discuss today, that is very, very basic and part of every technician's toolbox, is what we call the trend line. So we're going to look at how we use trend lines to identify trends and trend reversals, and the types of trend lines that you can actually use on your charts. So starting off with one chart right here of the Sensex dating all the way back to 2003, the first thing I would want to tell you is that in every technical charting software, you will find there are two types of trend lines that you can use. The first type is what we call the normal trend line, and the second one is a semi-log trend line or a logarithmic trend line. Now, why this is important is that you may be using normal scale on most of your charts. A normal scale is where on the y-axis, when you look at the price data, you will always see the difference between the various data points to be exactly the same, which means the Sensex, a centimeter move on the Sensex might be 200 points or 500 points. So we are talking in points. So when the x-axis is scaled in number of points, we call that an arithmetic or a linear scale. Now, usually when you're doing short-term charts, a linear scale is good, but when you're doing a very long-term chart, like when you're looking at maybe several years of data or where prices have moved up by maybe 100% or more, then it's better to actually use logarithmic scale charts, especially people who use the Elliott wave theory like logarithmic scale charts. What is a logarithmic scale? So unlike an arithmetic scale where the distance is the same for a certain number of points, on a logarithmic scale, the distance is the same for a certain percentage. So every 1 centimeter move could be 5% or it could be 10%. So on this chart, I'm going to show you, you have this tool here which says semi-log scale. Moment I change that, the chart becomes an arithmetic scale where each move here from 3000 to 3500, 3500 to 4000 is exactly 500 points. Now when we move to a semi-log scale, you notice it changes slightly, where the distance appears to get compressed between these points because it is trying to equate a certain percentage for the same size on the screen rather than a certain number of points. Okay, so typically when we do long-term charting, when we are looking at several years of data or where very big moves have occurred, we like to use a logarithmic scale. And so when you're using a logarithmic scale, you want to use a semi-log trend line. Because if you use a normal trend line on a semi-log scale, it will end up curving, looking like not a straight line, but actually a curved line. Okay, so you have to choose the right trend line on the chart that you're picking. Now, once you've picked a chart, and so we're using this chart of the Sensex from 2003, the object is how do you really start drawing trend lines. You can choose any time frame and then look at the highest and lowest points. The object of using a trend line is essentially to determine what is the trend the market is in and when are you going to get a trend reversal. So these are the two things that you're trying to use a trend line for. So once we can see prices moving in a particular direction, classic Dow theory tells you that you should be looking for higher tops and higher bottoms. But the real question is the trend still on or has the trend reversed? So here we are looking at a significant low that the market made, and from there we are going to start trying to draw a trend line on the way up. So the first thing I'm doing is I'm taking the first two bottoms that I can see on this chart and joining them. I'm joining the lowest price points on this chart. Note that I'm using a bar chart, which means that for each line you can see the high and low for each day. This is a daily chart. So this green bar here represents the low and the high. You can also draw trend lines on a line chart. So if I switch to a line graph, then if I wanted to draw a trend line from the low points of the two lows, I would have to join these two lows like this. But bar charts is what I like more. You can always switch between the two sometimes to make different price patterns. But if you are using a bar chart, which is most common among technicians, then you just join these two lowest price points and you've made your basic trend line. Now to determine where prices are going, what we do is we extend a trend line to the right side. The right side because prices continue to plot each day on the right hand side, one day at a time. Now that I've pulled this trend line forward on the right side, unless prices actually fall below this line, we do not have what we call a trend reversal. Now, a trend is very, very strong. It's very much possible that the next higher bottom ends up being very, very far away from price. Now, at this point of time, a technician will redraw his trend lines to include the new price action. So, the purpose of drawing a trend line from low to low in an upward trend or high to high in a downward trend is to include all the price action that occurs inside the trend line. So, when I've drawn this line, you notice that all the price action is above the line. There is no price action below the line. And only once a higher bottom has been established and prices are still rising in that direction, that I choose to actually extend this line higher and draw what we call a new trend line for this trend. And note that while I take these lows, all the price action is still above the trend. Now, as a trend continues to extend, a technician will redraw trend lines till the point where he has a trend line that is tested many, many times and becomes the strong actionable support line for the entire move. So, what you're seeing here is once this trend took off, we had multiple support points develop along this line. Once, twice, thrice, each time prices dipped, they ended up taking support till this point where they actually started to show some breakdown of the line. Now, when you start getting this breakdown is where you start anticipating a trend reversal. Okay, so this is where the trend reversal becomes apparent, and this is where the trend reversal becomes more certain. So, I'm going to pull back this line a bit. Okay, so sometimes you may get an exit or a closeout based on a trend line reversal that can be early on in the trade. One of the ways to deal with that is look at the higher top and higher bottom structure. So, if this previous low is not broken, then we may consider that this trend line break is an early indication of a trend reversal, but not a trend reversal as yet. As this trend goes on and we continue to mark the higher tops and bottoms, we finally get a reversal at this point of time where the higher top, higher bottom structure has completely reversed. But note that if you actually took entry into this trade at any point in this move, the trend line would have helped you ride it as far as possible. To a trader, it really doesn't matter whether you exited here or you exited here, because the point is really to capture maximum gains that you can till the trend really changes. Now, trend lines can be drawn in various time degrees. So, here we have drawn it on this daily time frame for this particular move. But note that this is a much larger trend in development, and after it sells off and makes a higher bottom of a slightly more medium term degree, it then becomes possible to draw a trend line for the larger trend as well. So, this is what I am doing now. Okay, I am pulling up this trend line to a new higher low and then extending it for the larger degree trend. Note how this newly drawn trend line is once again giving you multiple supports over a much longer time horizon. Okay, and therefore, it becomes an important trend line to capture what has been an almost 6-month period of rising prices that ended up seeing the Sensex almost double between 2003 and early 2004. Okay, and the first time that you actually got a break in prices was somewhere here, after which prices moved up a bit again. So, you will notice that many times when trend lines break for the first time, you actually get a counter trend bounce back, which gives you a better exit opportunity. So, the trend line break itself is an early indication of trend reversal, but not the reversal itself. You will often get a pullback either to a new high or to a lower high before the trend down continues, and therefore, you get a further exit point. The actual break is essentially a warning that a trend reversal is coming. But using trend lines in this way, you could have captured this entire move which started in May of 2003 all the way to Jan of 2004, almost seeing the index double during this time period, and you would have gotten a reversal at a much later point. So, trend lines can be drawn at different time degrees. Like I said, if you're trying to capture the short term trend here between July and August, you could have done so. Similarly, if you wanted to capture this entire trend from December to January, you could have done so. Or if you wanted to capture the 6-month long trend using a trend line, you could have done that as well. The important part of learning trend lines is that trend lines keep changing as the trend continues, and you need to keep adjusting it to the most important points where support is found repeatedly. Also, that all the price action when support is found repeatedly will end up being above the line. So as you can see, even on this medium term trend line, the entire trend ends up being above the line. So if you've drawn a trend line properly, you'll find all price action is above it in a rising trend. Similarly, if I draw a trend line for a downward trend, all price action should end up being below the trend line. So I would start drawing a falling trend line from these highs to try and capture the initial down move and then to capture a larger part of this down move. And when you're, of course, this is a correction within a larger bullish trend, but when you're in a bear market or a bearish trend, you will find trend lines that can have multiple resistance levels repeatedly and can allow you to capture months of downward trend, as I'm showing on this particular chart. This line held out for almost a 6-month period of downward trend, and the trend only reversed over here. So that's it from me on this short update. The use of trend lines is a very, very dynamic process, and it ends up being the first tool that every technician uses, and a tool that he ends up using for the rest of his life. And it will always be part of your toolbox. What's important is choosing the right line based on the scale that you're using, and then dynamically changing it to fit the required trend in your analysis.